Okay, let's go through this exercise that asks us to determine the change in cash due to operating activities. Now the solution is right there, okay, but let me show you how we get to that solution. Okay, we're given financial statements, a balance sheet anyway, at two periods of time for Evergreen, right? We have the end of the year and the beginning of the year. And remember that the beginning of the year is the same as the end of the year from the year before. Okay? They also tell us that the change in retained earnings was due to net income of $55,000 and payments of $7,000 in dividends. And then we have all these other balance sheet items and liability items and stockholders' equity items provided on the balance sheet. So let me slide down and I'll show you how we would work this one. Okay, so now what I've done is I've put those amounts that were provided and I've calculated the increases and the decreases. And to calculate the change in working capital accounts, what we do is we start off with net income and then we have to adjust it for non-cash items to derive the increase and decrease in cash from operations. We're only dealing with the cash that's provided or used in operations. So we're only tackling one of the three areas of the cash flow statement on this exercise. All right, so we ignore the cash account. You always do that, and you go through all the other working capital accounts. Working capital accounts mean current assets less current liabilities. So we have to go through all of those. So accounts receivable, what did it do? It decreased during the year. Any decreases in current assets are reflected as a positive adjustment. And that's because what we're assuming is the decrease resulted in us gaining more cash. So we've got a $3,000 decrease in accounts receivable. We've got a $14,000 increase, so it goes the opposite direction. Same thing with prepaid expenses. All right. On the liability side, liabilities go the opposite way. If the liabilities go up, we assume that means we conserve more cash. That has a positive impact. So in this case, liabilities dropped, so it has a negative adjustment, but salaries payable increased, so we have a positive adjustment. So when we consider all of those changes, the net of those, if you were to sum all those changes, comes to $9,000. That's the change in working capital accounts, excluding the cash account. And they gave us net income, so we take the net income and we add in the change, which was a negative $9,000, and we've calculated the increase and decrease in cash from operations. Now, one thing this problem doesn't give you is depreciation. Usually the other item you have to consider when you're calculating the change in working capital, what you need to consider when you are changing or when you are calculating the cash flow from operations is you have to adjust for non-cash items that were in net income. This problem didn't have any, but usually depreciation needs to be added back, and that's because depreciation is an expense that doesn't involve cash. Okay, when we record depreciation, we increase depreciation expense and increase accumulated depreciation. Neither of those accounts involve the cash account. And that's why normally when we have to add back depreciation when we're calculating the change in the cash flow from operations. Okay, hope you found this helpful.